Hello, my name is Todd Doleshal. I'm a financial advisor and I've been in the industry for 16 years now and own my own company, Elevated Retirement Solutions. And now that I've gotten that disclosure out of the way, what we're going to be talking about today is the recent market volatility and the drop. Is it a blip on the radar or cause for a concern such as a recession? So first, we're going to talk through really what's happened, what a recession is, and some ideas I've been working on with my clients really to help prepare them for this dip that we saw pretty dramatically in the middle of July that also has continued here through August in different intervals. So a couple things to talk through. Growth-oriented companies, to break this down, are those types of stocks that typically have higher growth aspirations. A couple that have been in the news a lot, we can go down the list, but essentially those companies, people are willing to pay a higher price over earnings, which is a very easy way to see, is a company overvalued or not. Think about when you go to the grocery store, we know how much a gallon of milk costs, filling up the gas tank, etc., right? So we've seen a really incredible increase in expectations because of these price increases. The problem, though, is as we continue to see those stocks climb higher and higher, it becomes virtually impossible for those companies to hit those unrealistic earnings expectations in the future. And then as a result, whenever there's bad news, such as jobs reports here coming out not quite as good, that's a lagging economic indicator, says that things aren't quite as strong as we might have thought originally. And that's part of what caused the markets to drop so much without getting in the weeds there. But all in all, a lot of organizations, especially those in technology, really were extremely overvalued, and these types of sell-offs are actually really good for the stock market. That prevents much bigger recessions and that take a lot longer to come through, such as 2008 real estate crash, the dot-com bubble, where you put up a website and all of a sudden you're a billion-dollar company with no earnings or customers. Absolutely ludicrous, of course. But with the hype around artificial intelligence, we've seen a lot of bubbles with that. And now finally, investors are demanding a return on literally billions of dollars spent on artificial intelligence research. It has a lot of promise, but as with any new technology or new field, there's a lot of wasted money, shocker. The other types of companies besides growth are those that are value. So value are much more established and mature businesses, typically Fortune 500 firms. They've been around in some cases for over a century. Everyone knows who they are, can go through some hallmark names, so to speak. And the idea there is that those investors are not willing to pay nearly as much for that as a price of earnings because everyone knows who they are. The growth prospects are just not that good. That's both a negative and a positive. The positive with those companies is when major sell-offs happen, they typically happen more on the growth side because growth are the ones that tend to get bid up again too quickly. And we've seen what we call in statistics reversion to the mean. A baseball player who's averaging 300, meaning that they get on base and hit 1 out of 3, they start hitting 600. Clearly they're due for a cold couple of months. And that's the same thing that happens with these stocks where they tend to go back and forth between growth and value, of which outperforms the other. And not surprisingly, a lot of value companies actually went up this past month while many growth stocks went down over double digits on a percentage basis. So that's why we want to own both and have a strategy. Also, another area that's pretty interesting is here we are in the middle of August and the Fed still has not dropped interest rates. We've been hearing for over a year from the experts that interest rates were going to drop. And that's what's caused a lot of uncertainty, especially in the bond market, that has caused bonds to lose money the last 3 years, unfortunately. And the idea there is as interest rates go up, bond values go down. And the problem is this year, bonds have gone up so much because there's an expectation that the Fed is going to drop interest rates, which again hasn't happened yet. Thankfully, it's looking very likely. Inflation reports are very strong. We came in at under 3% again here from July to July, which is the Fed's target. So hopefully that means that interest rates will drop here a quarter point in the month of September. But as with anything, Why put a ton of stock in that? Literally because there's lots of money market accounts that are out there that I have invested for clients. They're still paying over 5%. And by the way, those don't go down in value because cash is cash. So when it comes to some different ideas as well, all my financial planning clients know this, that I set aside at least 24 months of expected expenses in retirement to cover their expenses on a monthly basis. So this is why when we see major downturns like 2022, when stocks and bonds were down double digits, bonds having their worst year in 40 years, stocks not doing much better, in fact worse, they have plenty of cash reserves sitting on the sidelines, even when cash is paying next to nothing. And that's why we hold cash in a portfolio, not for offense, but for defense, right? Companies don't invest the money that they're going to pay you if you're working in the stock market. That would be ludicrous, right? But we unfortunately invest the same way. So we do need to have an escrow account to pay for expenses in a down market, because we will have major downturns right when we need expenses in retirement or otherwise. So having a plan set aside for that money is really critical. And lastly is, of course, as well, when we look at the market, no, we're not in a recession, despite what you may hear from headlines or clickbait that's out there. The definition of a recession is 2 quarters in a row of negative GDP growth, or gross domestic product. That's essentially money that comes into the United States versus that leaves. And because we have an incredible amount of capital investments that's coming into the world, arguably the highest in the world based on any data that you look at, that's what more than makes up for our trade deficit, where we import things from all over the world. And that's a good thing, because we're able to generate a higher return again in the stock market than what we can import and borrow from other companies, and also, of course, countries as well. So no, we're not in a recession. 2 very, very strong quarters in a row. In fact, inflation was almost a full percentage point higher than what the experts expected. So quite the opposite of a recession. So thank you for listening to my first market update here. It's certainly going to be an interesting year as we head closer and closer to this unique election, and really excited to continue to work with you if I have you on the books. And if not, please click the link below and we'll get some time set up to bounce some ideas back and forth.